And next up, we're going to have Todd Horowitz. Todd began his trading career in 1980 at the Chicago Board of Options Exchange. He traded in many pits, including BMY, IBM, and many other equities. Todd was one of the original traders in the OEX, and he helped start the SPX. He is a member of the Chicago Mercantile Exchange, where he trades S&P futures as well as foreign currencies. Todd then continued to trade electronically while developing other businesses, including manufacturing and marketing products for chain stores, Walmart, Sears, Kmart, and many others. From 2002 to present day, Todd is a member of Chicago Board of Trade, where he traded the Dow bond and grain pits. He joined the CWS trading in 2004 as Managing Director and CFO. CWS is a boutique proprietary trading firm that specializes in index, futures, options, and spreading. Todd has enjoyed a successful 30-year business career that has taken him all over the financial map. He went from a top marketing representative for Pitney Bowes to trading on the floor of the world's major future and options exchanges, to negotiating multi-million-dollar merchandising contracts in all parts of the world. Currently, Todd is devoting his full time to trading and trading the markets and training traders of all levels of stock, option, and commodities.
Awesome. Thank you so much. Welcome, everybody. It's great to be here. I'm happy to be a part of your Saturday morning, and you know, it's always exciting to be involved in the markets. I have been involved in the markets actually since I was 21, and I've been doing this now this is my 35th year. As stated, I started out on the Chicago Board of Options Exchange, and now I'm involved in the option market, which was my initial background, but I do understand all of the markets from binary options to regular options to equities to futures, everything across the board. And I am a regular contributor to Fox, CNBC, and Bloomberg, as well as having my own radio show each and every day. So I do love the markets, and hopefully when we get through here, you'll love what we have to say, and you'll love them too. My partner in this venture is Adam Mesh. Adam spent 17 years as an electronic trader. That's what made the marriage between Adam and myself so perfect, is because Adam learned the hard part first, which is the retail trade, which is what we're doing now, because most of us now are what we call screen traders. I was a floor trader. I was a floor trader for most of my adult trading life before the floors had started to die out. When I go back into the trading world, when I first started, we started with options that only traded on a quarterly basis. But so the marriage between Adam and myself is perfect because I have the floor trading and all of the strategy methods. Adam's got the experience on the screen, so it makes for a great adventure for everybody out there that's listening. So today's agenda, what we're going to do is we're going to talk about what is the origin of the option money machine. We're going to define what our strategy is, because you know every strategy has to have a definition of why you're doing this. What makes options money machine so exciting, or in our words, we call it a virtual ATM. Real life examples of the strategy in action. How we did in January's 1,000 point drop. February perfection. What are we doing right now? Because we'll show you right up to date as to what we're doing. Hold on, there we go. And how you can take advantage. Okay, and at the end I will take questions. If anybody has questions, I will take live questions, and you can ask me whatever you want. I will answer any question you want on any market. But the origin of the options money machine, I started using this strategy, as I said, 35 years ago. In fact, I go back to the day in the market when they only had call options. They did not have put options, okay? And as they worked out, when options first came out, they came out on a calls only, and then they added puts, okay? But they had quarterly options and quarterly expirations only. As time has moved on, options went from quarterly expirations to monthly expirations, and now about 3 years ago, they went to some weekly expirations, and they tried the weekly expirations in some of the major players, the S&P, the SPY, Apple, Google, and some of the bigger stocks. And we had a different expiration each and every week. And then they found that this was really the way to go, and that it created a lot more activity as a trader, and it gave traders a lot more opportunity to go ahead and learn the business and learn how to trade it. And what I have found out is that these weekly options now recreate what I was able to do on the floor for all of those years. And now as a retail trader, or as a screen trader, it gives us the same advantage to allow us to compete with the market makers. So the options is we started this. I have always been an options guy, and to this day I'm still basically an option guy. And Adam was always a stock guy. He refused to look at options. In fact, the way that Adam and I met was he was writing articles about options and how stocks were much better. And finally we talked, and we decided that he decided that options were okay, and he was going to go ahead and accept them as part of his teaching, although he still at that point did not believe in options. So a year ago I said to him, I said, look, Adam, you've got to trade. You love to trade. It's what you do. Okay, why don't you give this strategy a try? I said, in fact, not only will I guarantee it, I will stake you. If you lose money, you don't lose. I'll pay the losses. If you make money, you keep all the money. So it started with a bet that he couldn't lose. And the theory, what I taught him is how to sell puts. What we did is we learned how to become the house. Now, wouldn't you like to become the house in Las Vegas? And that's what I taught Adam, and that's what trading is about, and learning how to put the odds and the advantage in your favor. And if you learn to do that, and if you learn what we're doing, as I go through today, I will show you some of the tricks of the trade. As you get through it, you will find out that by being the house, you have the advantage to take the premium and become actually an insurance man. And we know that insurance companies, well, how many insurance companies do you know that have gone out of business? Not very many, right? They continue to collect those premiums. Why? Because they have actuaries writing their tables and telling them what their premiums are worth. Well, we're able to write the premiums, and we know, based on what the market makers do, based on what goes on in the trading world, what the proper premium is. And just so you understand who uses this strategy are big guys: Carl Icahn, active investor; Ackman, Soros, all of them. Why? Because this is how they enter these big stock positions. Okay? What they're doing is they're going to go ahead and sell puts first to create a buying point of where they want to buy that stock anyways, and they're going to take that money, put it in their pocket, and then go ahead and finance the rest of the deal by taking in that premium. So when Adam and I started this, and I showed Adam this, and I told him about Herbalife and Carl Icahn, we made a deal. We would do 17 trades between last August and the end of the year, and what do you know? We had 17 winners in a row. Now, obviously, every trade is not going to be a winner, but this is something that we work on. So what is our strategy? Okay, we're going to take advantage of weekly options, which began, as I said, about 2 to 3 years ago. Okay, this is what hedge fund guys are doing. It's also an income strategy that is going to average approximately $140 per trade, okay, which comes out to about a 93% annualized return. Now, this is not, if you are looking to hit a grand slam and get rich tomorrow, this is not going to be a method or a system that you're going to want to use. This is what we call like the grandfather strategy. This is the system that you use to continue to churn money out and make small money every single week to allow yourself to move on and continue to be profitable. What makes it so exciting? Okay, trading is an interesting thing, and if you listen to the last webinar, one of the key things that he said was discipline. This strategy keeps you disciplined. Look, bottom line is, in this business, if you are not disciplined, you are not going to make money. Okay, it's as simple as I can put it. If you don't have the discipline, can you get lucky? Yes, you can get lucky on any one given trade. But over a long period of time, if you do not have the discipline to play, you will not survive. And if you've ever played any games in your life, such as poker, backgammon, gin, or bridge, those games and trading are all the same thing. Those are not games of chance. Those are games of skill. And what we're going to teach you here is a game of skill. Now, just because you have the better skill does not guarantee that you will win every time. But what we're telling you here is that if you get disciplined, then that will get you organized, and that will get you paid every week. Okay? Now, what makes this so exciting is the ability to go back in time. Okay, think about it. You know, if you look at a trade, and maybe you made a trade, maybe you wanted to trade a stock like Starbucks, and you thought once it created and ran through the 70 level a couple of weeks ago or a couple of months ago, you said, you know what, I bought it, but man, I wish I would have bought some more. Well, this service and this system can teach you how to go back in the Wayback Machine or in a time machine, as you can see our cute little time machine here, and actually get yourself back involved at that same level that you were involved in to begin, that you wanted to get involved in to begin with. And I think that's very important to understand is that what we're working at, what we like to do is we're trying to identify the levels. And here is the exact example of this trade of Starbucks. Starbucks was trading, it broke through the 70 level. We actually bought the stock, and then right away it went to 72.50. And at 72.50, we looked at each other and said, you know, we wish we would have bought more stock. And I said, Adam, this is the method that I've taught you, that if you want to buy more, what you can now do is you can sell an out-of-the-money weekly put at the 70 level that will do one of two things. It will give you a chance to collect a premium, like the insurance guy, put some money in your pocket while you're waiting, or it will put you back in that stock at $70 a share. So what did Adam do? He took at the time, he took the 72.50 put, and he sold the stock was trading at 72.50. He sold the 70 put for 67 cents. He sold 3 contracts. He immediately collected $201, okay? For that $201, his risk was nothing down to, until we got down to 70, he had no risk. He was going to collect and keep that premium under any circumstances. He was actually showing himself that he can synthetically buy that stock at $69.33. Now, what does that mean? Well, we wanted to buy it at $70 anyways. So if we're going to buy it at $69.33, we are buying it at a better price to begin with. So there's nothing for us to think about. It's a no-brainer. So what we're doing is we're able to collect a premium, generate a better yield on a stock that we want to buy anyways without always having to take delivery. So what we do is we learn how to churn this every week. But if you watch how the charts work, why did we pick Starbucks? We thought the support level was great. We had a head start. We got into our entry, and this is obviously where the stock is going, and it's right about where the stock is right now. Okay? Now, another example of what this does. Now, this is very important to understand as well. You're only going to sell puts on stocks that you want to own. Okay? If you don't want to own that stock, we're not going to be trading stock puts and selling puts in stocks like Netflix and Amazon and big high flyer momentum stocks. Why? Because that's not what we do. That is not the guaranteed safety type of trade. That's the higher risk trade. Now, there are many people who make those trades as well, but for what we're trying to do for the options money machine, this is a grind it out, win it as often as you can, and return almost 100% annually on your portfolio. So as we look at silver wheaton, look at the support level. Look at the chart. Look at how it held. It kept staying around the 20 level, major support. So what did we do? We sold some puts on silver wheaton. We collected, and then we found a new level up here at 22. Okay? And guess what? We sold puts again. Now, we sold the 22 puts with 7 days to expiration, so we had to hold this trade for 7 days. We sold them for 30 cents. Now, I know you say, well, 30 cents, what does that mean? Well, if you annualize the 30 cents out, okay, that's $1,500 a year on a $2,200 investment. Think about that for a minute. $1,500 return on a $2,200 investment. That's pretty damn good. So when you look at this, you go, okay, now what happens when something goes a little bit wrong? You end up owning the stock, which goes back to the thing that we said that you want to, if you're going to sell a put on a stock, that means you want to own that stock. So guess what? The stock sold off a little bit. It actually expired at $21.70, which was actually our price. And how do we know that was our price? Well, we sold the 22 put, which means that somebody made us buy that stock at $22, but we already collected 30 cents, so that made our cost $21.70. Now, the beauty is not only do we take care of the stock and help you with the recommendations, but we also manage the trade. So what we did is we took delivery, and we said, okay, fine, we're happy. We wanted to own this stock anyways, so let's take delivery at $21.70. And what we do is we put a stop in, but look what happened. Boom, the stock went flying. It went to 25. And we actually sold this position out for about $1,000 profit, okay? So as we were collecting and as we're taking the $140 a week per trade and the $300 a week in total profit, once in a while we catch the big one, which brings our returns up to almost 100% a year. Now, here's another stock, Walgreens. Safe, not going a big places, not a high flyer, very safely done. And notice the support level in Walgreens. Notice how it moved up. And we've done Walgreens 6 or 7 times throughout the life of this service. And, of course, it's always about the same thing. You have to remember what you're doing here. We talk about it a lot. Discipline, where you at, and what are the projections, and do you want to own that stock? Okay? Walgreens works out beautifully. Altria Group. Now, this is one we traded another 4 or 5 times. We identified the level down here at 35. We started selling puts and collecting, and all the way up, the stock just kept going. Now the stock is over, it's almost 42 now. Now, we're not in the stock right now, but we collected $100 a week, $80 a week. And again, the idea of what we're trying to do here is to share with you and show you how to collect on a regular basis and put money in your pocket. Because at the end of the day, very few of us are ever going to catch that home run trade. So if we learn how to capture and how to turn over these trades on a weekly basis, every week, week after week, and put a little bit of money in our pocket, guess what? If you start with an account of 10 or 15,000 and you make it 20, then you make it 30 because you continue to grow organically with the trades. But again, it's always the stocks you want to own. You see Microsoft. So have you seen one high beta stock in here, one high flyer, one momentum stock? No. Because at the end of the day, those are not the stocks that you're going to make the money on a consistent, regular basis. Yes, you will have the big winners in those, and we're not telling you not to trade those. But what we're trying to do with this is to show with you how you can churn regular returns on your own every single week by following our weekly webinar and what we do. Okay, Microsoft, you see the level, how it held? You see the level again, how it held? And actually, we had one losing trade in Microsoft, and that was right here. We got stopped out at the absolute bottom. After we got assigned the stock and owned the stock, we got stopped out at the absolute bottom tick. And hey, that's fine. There's nothing wrong with losers. One of the big things that we as investors and traders have to recognize is your loser is your first step to your next winning trade. Because you're going to have losers. Believe me, my next loser will be my 1/1,000,000th. But you know what? It's 35 years later, and I'm still trading, so I guess that I'm doing something right. Okay. eBay. Now, eBay was a stock that was in a state of flux. It was going through with Carl Icahn, and there was all kinds of things going on with that stock. And what did we find out? That when stocks are not moving, when stocks want to be in a period of consolidation, we're going to make money as well. So we don't necessarily need. Now, the beauty of doing these types of trades is you don't have to be right. You can even be wrong a little bit. Think about that for a minute. How many trades can you make that you can be slightly wrong and still make money? That's got to be pretty exciting. And why? Because what we're doing to begin with is we are selling a little bit of a premium in the head to get a head start. So in eBay, we sold the 52 put, and we sold that for 70 cents. Now think about this. We had a 70-cent head start at 52, okay, no matter what happened. Well, actually, the stock was already at 52.50, so we had a $1.20 head start. So even the stock went down $1.20 from where we thought it was correct. Guess what? We didn't lose any money, and we had a chance to make money. And this, I will give Adam credit. This is one of his favorites, and we've done nothing but make money on Verizon every time it comes back to a level. Again, it comes down to, remember, the stocks that you want to own, stocks that you want to put in your long-term portfolio, most of them will pay dividends, so if we end up owning them, we're not afraid. We're never afraid to own the stock, okay? Now, in January, the market had a 1,000-point drop. We're selling puts, which is a bullish strategy, okay? Typically, you go, well, how can you make money when the market goes down? Well, what happens is it goes down to the identification of the right types of stocks. Okay, that means staying away from the high flyers. It means staying away from all of the ridiculous action that goes on every single day. It means staying away from Tesla, Netflix. And now, again, not that you can't make money in those, but this strategy is designed for your grandparents. This is a strategy that's designed for your mom. Okay, this is a strategy that's designed to bring you in a check each and every week. So in January, in the 1,000-point drop, we had our biggest month ever. Okay, we had our biggest month ever. Why? Because we did actually take some delivery on a couple of stocks, and they popped our way. But of all of our sales, look at the 100% winners. 800% winners. Two stocks that we ended up owning that ended up being big winners as well. So January, 1,000-point drop, our best month ever. February, we made 12 trades in February, all 100% winners. Now think about that. Look at the names: Starbucks, eBay, Potash, Gold Miners, Verizon, Line, eBay, Silver Wheaton, Altria. Okay, again, we're going to teach you how to repeat the process over and over and over again. That's what this is all about. Okay. Now, if you understand what you're looking at, now this was the most. We made 2 trades in higher flying stocks in the entire history of the program. Okay. Guild Sciences. Now, this is the reason I'm bringing Guild up here is because here we also do what are called credit spreads, or for those of you who have some familiarity with options, are bull put spreads. Because for those of us who may not want to take delivery but want to benefit from the system and the strategy, you can do a spread. What is the difference between doing an outright naked put and a spread? The cost of the margin. Okay, you make a little bit more money on the outright because you have to put up a little bit more money. Percentage-wise, you're going to make this just as much on the credit spread. So we teach you how to spread 2 options together to create that net credit, to create that insurance premium, to create yourself into the best possible position to win. And that is something that you have to also understand when you're looking at this service, is you say, how do we do it? Okay. LNG, another beautiful trade. Now, this is an old chart, but I loved LNG, and I loved it at this level. And sure enough, we get paid. Okay. How are we getting paid? Because we're getting paid because we're identifying solid levels and stocks we want to own that tell you that you're in the driver's seat. Okay. Again, I like to always refer back to insurance companies because insurance companies are in the driver's seat. okay? And when insurance companies are in the driver's seat, they're telling you that you are overpaying. You are overpaying for insurance. But why do we buy insurance? Well, because we need insurance. So if we're buying insurance, we have to have it, and that's the whole key, okay? People are going to buy insurance, and you hear people talking about insurance all the time. Okay, you hear people talking on TV. Well, buy those cheap puts because they're going to protect your portfolio. No, 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 no. We don't want to buy cheap puts. We want to sell them because we're telling you that mathematically, based on the chart, it's correct. Here's a stock we've done. We've done Wells Fargo every week for the last 5 weeks. We've sold puts on Wells Fargo, and of course you can see how the stock just keeps going up every single week. So every single week we're generating based on, again, the chart pattern. Silver Wheaton, we talked about this one a little bit earlier, but here's the base, here's the chart stretched out a little bit longer, and here we are back at the same level. Okay? U.S. Steel. This trade happened to be a loser. We got stopped out just by accident, but that's going to happen, and there is no guarantee in the overall business. You're not going to get, I can't tell you that you're going to make every single trade every single week. But I can tell you that since we've been doing this, we've made 93 trades. We have 84 cash outs and 9 losers. Okay? 84 and 9. It's a pretty good success rate. But the very key goes back to what we opened up with, and we said, if you're disciplined, which is what this service and what we do, is we will not do it without the discipline. And what it does is every single Thursday, Adam and I do a great webinar. We break down these trades every single Thursday. We look at them. We go through them live on the call together. Okay? We don't pre-plan it and say these are the ones we're going to. We look at it together and we decide where are we in the overall system, and what is going to take the best trade for us. And when we find that best trade, we then go ahead and put it on. And we have a lot of things that we look at that mean liquidity, the ability to get in and out, and do everything together, okay? So what we look for is how you can take advantage of what's going on. And that's weekly options picks that every week we identify the optimal trades for your portfolio. With portfolio management, okay, we manage every trade, and not only do we manage every trade, but we are trading every trade right alongside with you. In fact, we allow everybody to get into the recommendations first before we make the trades, okay? Very important, because when you're using this type of system, it's based on chart recognition, pattern recognition, putting yourself in the best position to succeed, whether you have, and the beauty about this is whether you have $5,000 to invest or $500,000 to invest, it works the same way. It works the same way. Selling puts is a derivative product that has gone on, and that's how I started out making my living 35 years ago when I could only do quarterlies. Now I can do weeklies, and I'm the happiest camper in town. Okay? The market analysis. Why behind every trade? Understanding the strategy. The strategy is simple. Every Thursday, you sell a put. The following Friday, we hope that it expires worthless. If not, we manage that trade for you. But basically, we put on 3 to 4 trades every single week. And basically, every week, we typically are able to cash out 3 to 4 trades. Again, sometimes we get assigned the stock, which goes back to you, the investor, trader, have to have the willingness to take delivery of the stock. But selling puts as a whole is by far the most misunderstood and the best strategy for the individual option trader. It's time for you to think about not buying premium anymore, but selling premium. And not selling premium to the call side. A lot of people go, well, what happens when the markets go down? Doesn't matter. The strategy still works. remember, we're collecting a premium based on a level in a stock. And if you recall, even in the market collapse of 2008, stocks still went up, okay? Stocks still went up even in the collapse. So again, this comes down to pattern recognition, chart recognition, discipline to make the proper trade, okay, and the willingness to take care of it and get in and out when you think that that is the correct thing to do. And that's what your focus should be, and whether you want to be a straight seller of puts or you want to learn to be a spreader, we do it all. We teach it to you all because we want you to be successful. Because at the end of the day, your success begets our success. And if you're making money, guess what? We're making money too, because we're making the same exact trades. We don't go out without putting everybody into the best possible position to succeed. So when you go back to the whole theory of what we're looking at, we're collecting an insurance premium. And wouldn't you like to be the guy collecting your insurance premiums? Because how many of us have ever actually made a claim? And that really is what it comes down to, is that this is a numbers mathematical proposition that at the end of the day will put you, the investor and the trader, in the best position. And you know what the worst thing that could happen? You end up owning a couple of stocks that you wanted to buy anyways. Is that such a bad proposition? Right? First prize is you get to keep this, all the money. Second prize is, guess what? I bought a stock I was trying to buy at that price anyways. So isn't that what this is all about? Okay? Now, if there's any questions, if anybody's got any questions for me, please feel free to, I think, type them in. I think that's how it works. I'm not sure. But certainly I'd be happy to answer anybody's questions about how this works and what we're doing. Let's see if I can find a Q&A box. I see there's some questions, but I don't know how to get to them. Oh, okay. Let's see here. Hold on. Maybe I did figure something out. Okay. What account size for naked put strategies? Great question. That can be anywhere from you could actually, people do it with less than 2,500. You can do it with any. If you're selling naked, you have to have enough capital. So we base our strategy on $15,000 portfolio. But for people that don't have 15,000, we teach you how to do it with less by using the spreads. We manage the portfolios by sending out updates when needed. Hopefully you never hear from us. Hopefully you only hear us on Thursday. But if need be, you get to hear from us more often, because when we have been assigned, the minute we get assigned, Adam and I get on the phone and we start writing together an update and tell you where to stop it and how to get out if there's a problem. Do you always sell put even in bear market, or do you sell call? We don't sell calls. We only sell puts in this particular strategy because that's what the strategy is. It's about finding the right opportunities. Remember, this is very important to understand. In a bear market, we will actually make more money because volatility will be higher. So you'll get paid more to identify good levels. You sound just like Tom Brokaw. I'd like to get paid like Tom Brokaw. Do you play with CL and GC? Crude oil and gold, you can email me independently on that. We would not do that on this call. That would be way out of our risk model, but I will certainly be able to talk to you. You can just email me at todd@adammesh.com. We have text and email updates and on an app. Yes, that's right. We do have email. We have text alerts, email alerts, and we have an app for your smartphone. Can this be done as an end-of-the-day trade? Yes, it can. You can do it anytime as long as you get the prices that we're looking for. And if there's a question, you can always shoot us an email. Can you trade options in Forex, viewing risking small, winning big? Forex is not a market that I necessarily recommend. It can be used, but again, this strategy is not for using in high-risk environments. We are looking to be in low-risk environments. That's what this is all about. Okay, so what we've done here is we've got some special group training that Adam and I will do together, and we actually have a 2-hour webinar You get access to a bonus, and you get training sessions with Adam and myself, okay? And how you can take advantage now, okay, is I want you to go to meshelite.com/MTI. That's meshelite.com/MTI, and hopefully they can chat that into the box for me, or I can do it myself. Let's see here. meshelite.com/MTI, and I'm going to send to the entire audience, and there it is. Oh, I didn't even spell it right, though. Huh. Okay, there. The top one is right. Meshelite. I don't type very well. I'm not a technical guy, but this is something, again, I've got my mother in it. I've got my son in it, okay? This is a way for you, the trader, to get involved, okay? And the offer is simple today, okay? We've got two offers. If you want to come aboard, normally this program goes for $1,995, okay? Today, we will offer this to you subscribers on a 2-year basis for $12.97, okay, which comes out to less than $14 a week, okay? We will offer this to you at a 35% discount on a 2-year package. Now, the good news is that after 30 days, if you say, you know, not for me, not my kind of product, you have the opportunity after 30 days to cancel. In the 30 days, if you do decide to cancel, you will have you will get back a refund of $10.97. Okay, but I'm telling you that we carry over a 90% success rate with our current subscribers. And this is limited to the first 50 people that want to get involved, because we have to keep down the number of people that can subscribe to this, because we have to take care of our own liquidity. The second part of it is if you only want to try it for a year, we would do that for $7.95 for the year with the 30-day guarantee, and you would get back $6.95 on after 30 days. But the reason we take a fee is because we give an enormous amount of customer service. If you email in with a question when you sign up for the service, you are not going to get a customer service rep. You are going to get Adam or me answering your question directly. Adam and I take this business very seriously, and we want to make sure that you take it seriously as well. And that's what we want to do, is we want to make sure that you get the best for your money. That's what it really comes down to, guys. My reputation is on the line, Adam's reputation on the line, and both of us are in the media all the time. I'm certainly not interested in getting involved in something that I didn't believe in, because I am very visible. Again, I mentioned with Fox, CNBC, Bloomberg, and my own radio show, I'm here to make this the best experience that you've ever had in the option market, okay? I want to take advantage of the offer, but I can't start until the end of the month. I will be out of the country till then. That's fine. You can sign up now, and I will take care of you. If you email me directly, I will make an arrangement for you. In fact, you can start if you sign up today, okay? But you can't start till the end of the month. All you have to do is give us a note, and we won't start your 30 days until you get back and say, hey, I'm back, I'm going to start, okay? And the beauty here, guys, is you're going to put yourself in the best advantage, okay? This is going to teach you how to generate regular capital on a regular basis, because really, what's it all about? If we look at the markets today, what's everybody doing? They're chasing yield. Well, we don't want to chase yield. I don't want to chase big stocks with big money. I want to start to create a small-time portfolio that, you know what, generates right now 93%. Okay, when's the last time you made 93%? Work it out. Work the numbers in your head. A little bit at a time, a little risk at a time, a very disciplined approach, and there you are. bang, zoom, you're ready to go. Now, for those of you who may, I want to do it bad, but I don't want to put up the bigger money right now. Can I try it by the month? And yes, you can. Okay. If you want to try it by the month, you can try it by the month. Now, the month, there is no 30-day guarantee. There is no 30-day guarantee. And on the monthly, it's $149 a month. Okay? It's $149 a month if you want to go on the monthly. Also, you can try it for a quarter. And again, on the monthly and the quarterly, there are no money-back guarantees. You're going to, because that, there's a lot of work for us to do, and Adam and I work diligently to make sure that you're doing the best that you can do. So we cannot do it, because otherwise it wouldn't make sense for us either. So you can do it monthly. You can do it annually. We recommend that, obviously, the best deal is the 2-year deal. Better credit spread than a debit spread? Absolutely. Debit spreads are no good. I will tell you this, and I know I don't have enough time to go through the dynamics, but credit spreads are no good. The debit versus credit, think about it this way. If you do a debit spread, you only have one way to win. If you do a debit spread, you only have one way to win. The stock has to go in the direction that you think it's going to go. If you do a credit spread or sell a naked, guess what? You have 3 ways to win. How do you win? The stock goes up, the stock does nothing, or the stock goes a little bit down. You make money on all 3 occasions. Why? Because we're taking advantage of the clock, and that's the beauty of selling options. Okay? Take advantage of the clock, and that's the beauty of selling options. Okay? If I try month, can I switch over to annual? Yeah, you can, but let me ask you a question. Wouldn't it make more sense to take if you're going to try it for a month, it's $149. You can do the annual for $795. It only costs you $100 for the month if you decide that it's not for you. So doesn't it make more sense to go ahead and do the yearly subscription? Quarterly is $349. How much of an account do we need to have to trade a spread? You can do spreads with as little as $2,500. We will tie up in spread capital approximately $800 to $1,000 a week. So as long as you have $2,500, because you have to have room to take losses, because sometimes there's going to be a losing week here and there. I mean, I'm not going to tell you differently. Okay, so you have to have enough to go back and forth. Okay, but quarterly is $349, monthly is $149, 1 year $795, 2 years $1297. The 1 year and a 2 year come back with a money back guarantee. You need to have a higher level to sell spreads or to sell naked, and you can also use this in an IRA account. For you people that want to make your IRAs look better, you can use them in an IRA. So don't be afraid. Again, we will explain all of this throughout the training webinars and the exhaustion that we go through, making sure that you understand it. How can you make money in a bear market, since this is a bullish strategy? Because stocks in a bear market still go up, and they don't always go down. And we benefit in consolidating markets, which are 65% of the time, and in bull markets, which is, let's say, the other, which is 17%. So if we balance it off, if you're working for good levels, you will find yourself being in the right stock at the right time. I do have a great broker for you. If you want to email me directly, todd@adamesh.com. I will be more than happy to recommend a great broker. We have great relationships with many brokers, and I'll be more than happy to help you there as well. But it's a great service that will help you, and we also do many other teaching while we're there in how to defend your portfolio. And at the end of the day, as we opened up with and as we'll close with, it always comes down to discipline.